So first of all, my e-learning, you know, our class is called Advanced Taxation. So this is Advanced Taxation. That's my name, and my class is Advanced Taxation. I'm gonna need eight times. We need 8 times. So I'll make a few comments, then we can start. So this will be our first class. Hatujakutana mara nyingine. So this will be a very first class. So I need to make a few comments, and then we can start. So usually my comments are very, very brief. First, the semester is very short, and of course that means we'll always be under pressure for time. We usually release the exam timetable. Exam inaanza tarehe ngapi? December 4. Haikuwa November. Niliona timetable, but I saw the schedule, but I didn't really go through it. Like, walituma schedule the dates of the exam. Ulisoma na ukadili, mimi niko nayo. So I'll check again. Nilikuwa nafikiri zinaanza around 27. Wewe uliona ni tarehe December. December 20 for a week. Yeah, for 5 days. 5 days. Okay, so at least you know that the exam will start first week of December on 4 for 5 days. So that gives us day is 13. Day is 13. So that gives us 2 weeks of September, October, and November peke yake. 2 weeks of, now that's like, let's say 2.5 months. 2.5 months to complete everything required on our syllabus. And again, you cannot rule out interruptions. The other semester we had so many interruptions, like Sazine Mandaman, no class, Ama holiday, no class. So you also can't rule out that. So probably effectively, we might just be having 2 months to study this content and finish. Now, so that's number one, that will have some constraint of time. But still, even with the constraint of time, it's important that whatever we do, we must understand, because otherwise, if you rush because of time and we are not really getting to understand what you've done, then it's still counterproductive, because the objective is to pass. The objective is to pass, and if the objective is to pass, then we need to understand whatever it is that we do. Now, the other thing I'll comment briefly on, though I'll be talking about this as we go on, is the exam itself. I'm sure you know, I'm sure you even start the other sitting, that the same time pressure we are facing while learning is the same time pressure you face in the exam, because this exam will require that you complete 5 questions. And these 5 questions must be done in 3 hours. And there is the challenge. I keep talking about the exam technique. You may know your material very well, but if you don't grasp the exam technique from the beginning, then you'll have a challenge of completing your paper, and then you'll have problems as far as passing is concerned. So usually we advise that you don't sit this paper just like any other paper. Don't follow the questions in serially the way they've been set. Because as you read through the questions, some will naturally require more time than others. Right? My advice is usually to think in terms of questions that will need the least time and start with those. Now, why is it important to start with questions that need the least time? 2 reasons. Probably there could be more reasons, right? But the main two reasons is all of us, naturally, you will feel some kind of nervousness, some kind of tension. So if you start with questions that need less time, they help you to settle in the exam. Right? Questions that are easier to handle, that might not push you really hard, will not only help you to settle in the exam, but they'll give you confidence. You'll start developing confidence that you're passing. That's one. Another reason why you might want to pick questions that are less challenging, that need less time, as you go through the 5 questions in the exam, is because you get to save time for the more difficult questions. And of course, the third reason, if you do the hardest question last, you are not only faster, because now your mind has settled and you've gained speed. You can think faster and you're more accurate at what you're doing. You'll have refined yourself as you do question 1. Sorry, as you've selected easier questions, right? So once you complete 2 easier questions or 3 easier questions, you are better now. Your nerves have settled. You've gained confidence. You're thinking more clearly. You're more efficient. Now that's when you have momentum to go over the difficult questions. In any case, what gives you confidence is I've already done 3 questions, or I've already done 3 questions. So even if you're told 2 hours gone, you are not in a panic mode. But imagine you started with the hardest question, and then it drags you for more than an hour and a half. Then you realize you've lost 1.5 hours. You can panic. And when you panic, you can't think. Now your confidence goes, and it might be very difficult for you the rest of the time. Okay, now with those few remarks, I wish to start with the first topic. Now, before I start, this unit will be purely taxation. Okay, initially, before change of syllabus, there was a bit of some theory we used to call public finance. Now that one has been, a few topics have been put together with section 4. Or sound. My signal here, Halima, is showing me a lot of green. Sasa sijui mimi ndio nazungumza kwa sauti ya chini. I don't know, because my signal inanionyesha that sound is perfect. Are you still having a problem with sound even now? Because here my signal is telling me my sound is fine. Are you still, the sound is going off and on. I don't know why the sound is going off and on. You could probably check also your side, probably, because my end, inanionyesha hapa that the microphone is green. Yeah, try. Hapa inanionyesha my signal is very strong. I'm seeing a very strong green signal. Okay, so with those few remarks, I want to start with the first topic. I was just at the point of telling you that this course will be purely taxation. So there will be nothing like, I don't even want to mention the other one because it will not be there. It's in intermediate now. And even in intermediate, we don't do everything we used to cover in public finance. It's only some topics. Okay, with that, I'll introduce the first topic. Our topic number 1 is called taxation of partnership. Taxation of partnership. Taxation of partnerships. Or taxation of partnership business, it will amount to the same thing. Taxation of partnerships or taxation of partnership business. Now, we will start this off with, I'll give you a formal definition of partnership, and we get this from the Partnership Act. There's a Partnership Act of Kenya, which is chapter 29 or Cap 29, which in summary says that a partnership is a relation. It's a relation that subsists between persons. It doesn't say how many. It's just a relation that subsists between persons who carry on a business in common. Together, they allocate themselves roles in common with the view of profits. Now, you'll find that definition very, very useful. It doesn't say a partnership is a business, even though it's a business. It just says it's a relation. And you'll find that very, very important, because even though there are certain, okay, these days we don't study partnership as deeply as we used to. You know, in the old syllabus, we even look at cases to prove whether there is a partnership or not. So you find a person probably with his 3 sons, and you give them details of the business, and you're asked to explain whether a partnership indeed existed, because we look at certain prerequisites, certain prerequisites. Was there a partnership deed? Was there contribution of capital? Was there sharing of profit? And so on. These days, the exam doesn't go that deep. You know, I would say we've had to make it brief because of time and because of content. So we don't go that direction. But we want to discuss a few things. First of all, a partnership, even though the prerequisites are met, there's a partnership deed that has been signed, the business has been registered, it has a name, and they can even open bank accounts and so on. It does not become legally a person. It does not become a legal entity. It is not recognized. You cannot take a partnership to court. It doesn't become a person. So who are the persons? The individuals, the persons who are carrying on business in common. The partnership itself is merely a relation. And that definition becomes very telling. It becomes very telling because even though at the end of it, we say they are carrying out, it's a relation between persons carrying on a business in common with the view to profit. With the view to profit. So there is a speculative motive. There's a speculative motive. So if any group of individuals are relating, carrying on any activity together, but if not for profit, then that will not be a partnership. Now, even though all that is present, that doesn't make this business a person legally. In other words, you cannot pay tax for partnership business. You cannot sue a partnership business. You cannot take the business to court. You can only take the individual partners. Now, that would be very telling because even though there is a speculative motive, and because of that, you must prepare accounts. Because how would you know you must prepare accounts, which, if possible, will even be audited. You'll prepare accounts, but that doesn't make it a person. So even though you prepare accounts, that profit doesn't belong to that business because the business does not exist legally. That profit belongs to the individuals. That's why in partnership we prepare 2 things. We'll prepare a statement of profit, but we'll still prepare a distribution schedule. The profit will have to be shared among the partners in their profit and loss sharing ratio so that each individual partner will pay tax. They'll bear the responsibility for tax as an individual. So we put down this definition. So you find this definition under the Partnership Act. So they've worked very hard. Even if you want to read the whole act, you can find it online. You can find Cap 29. It will be online, the Partnership Act. But even if you don't have time, the only thing we'll draw from the whole of the Partnership Act is only the definition. So if you trust that we've drawn it correctly, then you don't need to go to the Partnership Act. Okay? So we say a partnership A partnership is defined. A partnership is defined by the Partnership Act. A partnership is defined by the Partnership Act, Cap 29 or Chapter 29. A partnership is defined by the Partnership Act, Cap 29, Laws of Kenya. Laws of Kenya. A partnership is defined by the Partnership Act, Cap 29, Laws of Kenya as. Now you can quote this. Open quote and say, the relation which subsists, the relation which subsists between persons. Doesn't say how many. So persons suggest more than one. The relation which subsists between persons carrying on a business in common, with a view of profits, end of quote. With a view of profit, end of quote. With a view of profit, end of quote. Then you continue and say, a partnership is not considered. A partnership is not considered as a legal entity. A partnership is not considered as a legal entity that is distinct and separate. That is distinct and separate. Is not considered as a legal entity that is distinct and separate from the partners. It is formed with the motive. It is formed with the motive. It is formed with the motive of sharing. It is formed with the motive of sharing profits. It is formed with the motive of sharing profits. Hence, it is implied. Hence, the profit of the business. The profit of the business is deemed. The profit of the business is deemed to be that of the partners. The profit of the business is deemed to be that of the partners. The profit of the business is deemed to be that of the partners and is shared among them. In their profits, is shared among them in their profit, or in brackets loss, and is shared among them in their profit, or in brackets loss, sharing ratio. In profits, in their profit or loss, sharing ratio. Any question up to that point? Then I'll ask you a question. Why is the profit considered to be that of the partners and not of the business? Why? Because it's not a person. It's not an artificial person. So the profit doesn't belong to it. It belongs to the individual. Any other reason why the profit doesn't belong to it and could belong to somebody else? Any other reason? Because of the motive. To make profits, okay, and also to share. And we just said their motive is to share. If their motive is to share, then it is implied this profit is shared. This profit is theirs. It doesn't belong to the business. Now that's very different from the way we handle a company. ya company unaweza kuuza. Hapana, hiyo ni ya kampuni. The company is a person. Safaricom can employ and fire. Safaricom doesn't, everybody else is an agent. That doesn't happen in partnership. So the partnership in its name cannot own anything, cannot even own profit. That's why the reason it is already implied when these people come together, we're here because we want to share. We're here because we want to share. That means the profit doesn't belong to it. For all those reasons we've given. It's not an entity. Okay? The purpose is to share. Okay? So the profit obviously cannot belong to it. It belongs to those who have formed it. Because they will eventually share. Okay. Now, that logically brings us to the next step. We've said in our definition, there's a motive. And the motive is to make profit. And if the motive is to make profits, then you know, being accountants, that they must prepare records. Because how will they know if they have a profit? Or sometimes they can even make losses. So that leads us logically to the next step. And the logical next step is statement of profit. Because that's where they are formed. If they are not making profit, chances are the partnership might not last. Because the motive, we've said the motive is sharing profit. So that logically leads us to the next step. So next step, you say statement of partnership profit. Statement of partnership profit, or in brackets loss. Statement of partnership profit, or in brackets loss. Statement of partnership profit, or in brackets loss. Now, in this step, we are not interested in finding out how they prepare that income statement. That's not our business here. But our business is to interrogate this statement, because that's what we'll be doing for exam purposes. So let me just put it to you from the beginning that the statement they prepare for their purposes here, for speculative purposes, is not the one we need for tax purposes. Do you know why? I'll repeat the question. They will prepare a statement, your accountants, you do that every day. They'll keep records, they'll keep ledger accounts and so on. We are not going into that. And they'll come up with a statement of income for the business, which will tell them whether they're making profit or not. Now we are saying what they have prepared is not what we require for tax purposes. Do you know why?
Maybe looking at maybe the expense. They are now.
Oh, your name, please? Dennis. Dennis here is saying probably it could be because of the expenses. He's talking about allowable and disallowable. What does that mean? He's talked about something. You have it. Said allowables and disallowables. What does that mean?
There are some things
That's right. That's right. They'll prepare the income statement, but we will have to adjust that statement. Always we'll have to adjust it. One of the reasons why we must adjust it is because of expenses. There are some expenses which have already gone through, or which will go through in preparing a profit for accounting purposes. But these expenses are not allowed for tax purposes. So we first need to take care of those. Indeed, in preparing our adjustment, we'll add them back to the reported profit. We'll take the reported profit and just add back those expenses there. Do you know of any examples?
Expenses that are not directly related to the business. No, the ones which are expenses that are directly related to the business.
Expenses that are directly related to the business. I just wanted specific examples. Like tell me this one, This expense, the other one. Can you think of any?
Yes.
Which one? Any expense which you think may not be accepted.
Excessive
Depreciation. Depreciation is one of them. It's true. Depreciation is one of them. Any other? Halima? Any other expense? Any other expense? Anyway, there are many. We'll be looking at them, like general provision for bad debts, like taxes that were paid, like an asset that has been written off, okay, amortization, and so on. We'll be looking at them, and probably I even propose reasons why they've been left out. You know, for tax purposes, you might not really be told why depreciation cannot be allowed, but here we'll explain why we cannot allow them. But that's not the only reason. Expenses. That in preparing the income statement for their accounting purposes, there'll be a difference between the profit they report and the one required for tax purposes. One of the reasons would be a list of expenses, which will take an advert. Are there any other reasons where we might need to adjust this income statement to arrive at the statement required for tax purposes? Could there be any other reason apart from expenses? Or it's only expenses? Is it only expenses, or there could be other reasons?
Also the profit before tax.
Profit before tax. Profit before tax. Actually, this would be profit before tax. The one they'll give in a statement would be profit before tax. So we are asking, what is wrong with this profit before tax? And we're saying, one thing that is wrong with this profit before tax are the expenses that went in there to arrive at the profit before tax. And some of those expenses may not be acceptable from tax point of view. And I'm asking, is this the only reason? Is this the only reason? Well, there may be many reasons. Probably today you're not thinking very hard, but there are many reasons. But in this class, I'll only propose 4 reasons. We've already suggested one of them, suggested by Dennis, expenses. Okay, but there are 3 others. For example, the other point I'm likely to add is in taxation. Income is not just income. Income is categorized. Income is classified. And the classifications are called specified sources. This is not a new provision. This is a very old provision. Specified sources. This provision, this is a very old provision. So what specified sources provision means, and when you're preparing your income statement for accounting purposes, you will not consider this. But it's important for tax purposes. The importance is this: income must be categorized separately according to the source. Why? We have rules. We have different provisions for dealing with different sources of income. I'll tell you, if the income is from employment, then it must be dealt with under payee rules. A payee is a system. PAYE is a system that uses a scale and has rules for computation of both benefits, okay, cash benefits and non-cash benefits from employment. So anything from employment must come under pay rules. Now, pay rules work on a month-to-month basis, from January to December. We call it a calendar year. But there are other incomes apart from employment, like business. And business, again, has categorization. In business, you could be trading, okay? You could be doing manufacturing. You could be doing a vocation, or you could be doing a business adventure. All those are forms of business, and there are rules to deal with them. Or you could also be involved in farming. There are rules for dealing with farming income or rent. I'm sure you know that we have provisions for dealing with rent. And we have what we call monthly rental income tax regime, where a landlord can opt to pay his taxes on a monthly basis, even though they've been given categorizations. They've been told you are under the new Finance Act 2023-2024, currently it's income up to 15 million shillings. It used to be up to 10. They are told a landlord can choose and say, if my rental income is up to 15 million, I'll be giving 7.5% monthly as tax on the gross, on the 15 million, on the gross, without deducting expenses. They have a choice to do that. Or they can use the standard rental income tax regime, which works annually. You accumulate income for the whole year, then you prepare a statement. You deduct your expenses. For the monthly one, you don't deduct expenses. You calculate it on the gross. In other words, I'm saying different sources of income have rules, provisions. The accountant does not know. So all these incomes will be put in one place in a statement. So what we do in correcting that, separate the sources and explain to the examiner how each source will be dealt with. Because the accountant might even include investment. So what is the investment income? Dividend, interest. Do they also have rules? They do. How do you tax dividends in this country? Denise, how do you tax dividends? You're looking like you've just arrived in this country. You live here, don't you? Halima, how do you tax dividends? You said you are? Yeah. Well, you didn't tell me. I think it's now ask for your name. Jonathan, how do you tax dividends? You're not new in this country. You live here. Denise, how do you tax dividends? Halima, una tax dividends namna gani? How do you tax dividends? Jonathan is thinking very hard. He's thinking very hard. How do you tax dividends? Have you heard of something called withholding tax? What is withholding tax? What is withholding tax?
5%.
5%. The 5% is in that the rule. He knew, but he was struggling. The 5% is the tax. So that when a company pays dividends, they will withhold. To withhold means to retain 5% and remit directly to KRA. Isn't that the rule? So if that same dividend is put in the income statement, do you tax it? No. Because we say the rule doesn't go like that. But the accountant will include it. This is part of the income this company received, dividends. But we know the rule is this type of income, there's a withholding tax. The company paying dividends, if you earn 100 shillings dividends, they will withhold 5 shillings. And they give you 95. The 5 will be remitted to KRAs. Is that the rule? Then another investment income is interest. How do you treat interest? How do you tax interest? What is the rule? How do you deal with interest?
Interest.
Yes, interest.
5%.
Interest income, 5%. How do you deal with interest income? Jonathan. Halima, how do you deal with interest? So you could earn very good interest from fixed deposits in a bank account, treasury bills, treasury bonds, infrastructure bonds. Like now the government is issuing bonds almost every other week because they need to finance their budget deficit. And banks are busy investing in those bonds. They also earn interest. How is it taxed? There's a withholding tax of 15%. There's a withholding tax of 15%, which again is remitted to KRA. So what am I saying in short? There are rules for each specified source of income. That's why when you're given the statement, you must distinguish. You must separate the sources, because we don't just lump them the way the accountant will lump them in one statement, because all of them will not be subjected to corporation tax. What we're supposed to subject to corporation tax is operating profit or trading income. Rent has its own rules. Investment income has its own rules. Farming income doesn't have, okay, it has rules also. Either you use presumptive tax of what rate? Presumptive tax is what rate? 20%. Or if it was not subjected to presumptive tax at the source, then you add it to income and tax it. If it was not already taxed. In other words, it's very important that we distinguish the sources, because each source has a provision. There's a way they are dealt. I cannot just add together incomes. Say this is from manufacturing, this is from rent, this is from farming, and I add together and I say 30%. It doesn't work like that. So there's a specified sources provisions which we'll take into consideration, where we have to separate each source, work it separately. Now, the rule says if any of the sources has a loss, for example, if there's a loss from family, the rule says that loss must be carried forward. That's what the rule says. I cannot, unajua zamani, before this provision, what a clever person would do, a clever person would say, since I have a loss from family, I'll offset it against manufacturing profit. You cannot do that. If you have any loss, you carry it forward. That's why this provision is important. So far we've discussed two reasons. And you'll need the reasons to understand the adjustments we'll be making in the income statement. Because we'll be adjusting the income statement to derive the profit required for tax purposes. The first reason, we talk about expenses. So we say there'll be expenses that have gone through the income statement, which are not, they have to be added back. Then we've talked about specified sources of income. Do you know of any other reason why the two incomes may not be the same? Why they should be different? You know of any other reason? Alima? You know of any other reason why they could be different? We call it reason number 3. Why would they be different? I'll propose a third reason where I'll be discussing capital expenditure. What is capital expenditure? What is capital expenditure? Jonathan, what is capital expenditure? You are an accountant. What is capital expenditure?
High value expenses.
High value expenses, it says. High value expenses. Dennis, you agree? High value expenses. Dennis agrees with you. Alima, you agree? Capital expenditure is high value expenses. Alima, you agree? I disagree. High value expenses might not necessarily be capital expenditure. It depends. You might be an accountant in a business where Alima disagrees. She said funds used by a company to acquire or upgrade and maintain physical assets. Though she doesn't say what physical assets are, right? But I agree with her. We are talking about maybe what has been used to buy furniture, computers, computer software, where these capital expenditure are simply for buying assets, as Alima says, that are now not going to be exhausted in 1 year. You'll use them for a number of years, so that you'll only be using probably a fraction or a portion of that asset for that 1 year. So simple things like partitions, and you'll find them in your income statement. they bought partitions, they bought computer software, they bought computers, okay? Now, any capital expenditure, as a rule, should not appear in the income statement, and they will be there. So you will correct them by adding them back to the reported profit. So if you're told this business had put up partitions worth this much, they put up a billboard or a signboard, you add back, because those are capital expenditure. You know them, capital expenditure items, motor vehicles and so on. But then, from tax point of view, we do a second adjustment. That second adjustment will be to grant an allowance. We call them investment allowances. In this country, I don't know why we do it. In this country, I don't know, there should be a debate. Should we do it or should we not? In this country, we give allowances for any expenditure on acquiring an asset. From tax point of view. And that is the reason why we disallow any other allowances granted from an accounting point of view, like depreciation. Because you'll be granting double allowance. So depreciation is what you give from an accounting point of view. But since we disallow that, or any other loss of a capital nature is disallowed, then we are going to grant tax allowances. We call them investment allowances. I think we should have a debate whether should we give them or should we not. We should have a debate on this. Should we continue providing, for example, if you put up an investment and you've acquired computers, we'll give you 25% of the cost on a reducing balance every year. If you buy motor vehicles for the big business, we'll give you 25% of the cost on a reducing balance every year. If you put up a factory building, we'll give you 50% in year one. Then year two, we give you 25% every year on a reducing balance. If you invest in plant and machinery, the same thing. So the big debate should be, is it necessary? Why is it not? What do you think? First of all, let me tell you, there are two main reasons. There could be others. There are two main reasons why we do this, why we give investment allowances. Two main reasons. There could be others. You could think of others. But the two main reasons. First reason is you are being encouraged because you've invested. This is meant to attract investment. It's meant to attract others to do the same thing. Foreign investors, even local investors, to create employment and to invest in the country. And the second reason is the investor is being compensated because these assets are losing value every year, except land. Why? Land doesn't lose value. Land appreciates. Why does land appreciate? Why would land appreciate, gentlemen? For nini land appreciate and doesn't depreciate. Even the shilling is depreciated, but land doesn't. Why not? Halima. Oh, Halima wants 10 minutes break, so let's take 10 minutes. I think she wants to pray. Okay, we'll take 10 minutes and then we'll continue. Okay, we come to now. Okay, I know that land appreciates. Yes, but I have never started why. You tell me why. Ladies can also tell me why. Yeah, so I didn't do all this, but you and no. Process person and manual process. So we have to lunch.
Jangan dia semua macam kita ni orang dia orang sana di Chinese, orang di Chinese. Understand? So itu. Dia orang test sedang, orang test sekarang, semua orang di dalam video. Jadi kita orang ada dua orang yang test, semua orang yang test mana kan dia orang di, nanti kita kamu nanti sang universitas. Sasa sindikato simpan apa ya? Kemudian sindikato itu juga akan yang ini sindikato. Ada apa? Zaman switch. Bukan switch. Senang dia yang biasa dan macam tu kan. Kalau dia bilang macam ni, dan dia berkata, tapi kenapa? Dia bilang macam ni. Dapat apa? Insi itu. Dia nak buat yang kursus makan yang kalau. Kok? Okay. Terus sampai di kita. Not water. So kan berapa? Mereka suka yang atas, ada sudah untuk pikirnya. Bukan aslinya, ya. Dia orang yang sudah buat kontak nak kerja. Ya, enak. Mana kan orang itu tu kok, unapenda kok pure. Kok, siapa yang kok punya bisnis? Ina cakap dulu kosong. Unahitaji si maji mereka, punya maji ada pun bukan mel, dia unapenda sudah apa? Ni ada apa? Ini tu mana? Macam biasa ada juga apa? What is that? I'm not dealing with salary now. I'm doing that. Oh, yeah. Ini just apa yang dan jika dekat dan di mana nantinya nggak bisa terbang apa sih? Kalau orang orang sebelumnya ada yang juga bisa. Oke ini jadi ini dua mixes. Itu mana mixes ini? So kami ini skill ini sebuah nah ini apa kita aku tidak kira kalau macam apa kita boleh ini ada juga after that one dia itu one kita perlu ini saja ini bagaimana kita apa sebelumnya apa yang dibikin itu kenapa dia sendiri ada jadi dia bukan keluarga dan amat yo sa oleh waktu ini ambil cikgu kalau semua kenapa cuma saya 6 months ya ini macam ini sendiri jadi kita kalau kita nak kalau di cara apa yang habis dan asal misalnya kalau dari apa yang kita sidang siaga atau pemikiran non dia dalam juga siapa siapa itu sedang sesuatu
So you must have found out, eh? So why doesn't land appreciate? Why does he only appreciate? Because of developments. Because of developments. Because of developments. Developments like that's why it always appreciates. How come land anywhere, even where there is no development, land will not depreciate in value, it will only appreciate. And it didn't start now. It started even in the 15th century. The history of land has been that of increasing in value. Hata kwanza na in the 21st century, hata kwanza 21st century, even in the 15th century, land was still appreciated. That has been the rule. If you didn't know, you're better know today. The question is why. And for land, we don't give the allowance. Because remember, we're trying to give allowance to compensate. And you only compensate for something that is losing value. Now, land is not losing value, so we don't compensate. So there's no investment allowance for land. So we're trying to see how come land appreciates in value. That's the main reason. That's the main reason that for ages, if I'm sure you know that the size of land has never increased. It is fixed from the time of creation. If you believe in creation, or what's the other theory of how the earth was formed? The other theory in whatever other theory. So what we must understand, from the formation, the size of land has never changed. But what has happened to the populations? They're increasing. From the early centuries, you can, like right now, the global population is 8 billion, 8 billion, thereabouts. 8 point something billion. It has never been like that. In China, they're already encouraging people to conduct burials in the sea rather than on land to ease pressure, because there is no other land near to. Would you manage to reserve land for burial? Because there will be no extra. That's the only land you've been given by the Almighty. So if you use it for burial, then very soon you'll be burying bodies of others. By the way, let me ask you an interesting question. Do you generally think there's space for burial in Manhattan? Anytime they are burying in Manhattan, they are not burying on fresh. They're not. Any ground they pick is because they cleared it. They just cleared the surface. So you're just burying on top of.
There's an option.
There's an option?
Like, when you buy space, I think you can buy permanent and it's not money temporary. That's what I was hearing. Yes,
but even that buying, you're just lazy.
Yes,
it's just to prolong the period of clearing, but eventually they will clear. It will just take longer. You can take flowers there for a few years. Then after those years, don't even come because it will not be there.
But also they encourage buying. Because there's one, I think it's an editor who was buying on top of the bank paying. You are allowed to encourage you buy on top of.
If you're involved,
family, yes.
So you can bring another family member on top.
Yes.
I didn't know that.
Yes, that person.
They allow that.
Yes.
But you still pay.
I think so.
But you bought. Why should you pay to be on top of another?
On top of the other family. don't know why it was a debate. I don't know why.
They allowed that.
Yeah, they allowed. It's happening in Ghana.
It's already happening.
Yes, but you find maybe the ones you don't know. No.
So they make a more shallower one,
Yes,
so that this other one can come on.
Yeah, another one.
Okay. So basically, we don't give allowances for land. I was explaining the third reason why you need to adjust the income statement prepared by an accountant is because you look for capital expenditure items. Then they are not allowed to start with, so they'll be added back. Then we also have to grant investment allowances. Then there's the last reason, a fourth reason. Once you understand the four, then you'll be able to understand how the adjustment works, how the mechanics works. The fourth reason will have to do with the income, in the sense that not all income is taxable. Can you believe it? There's some incomes that are not taxable. Can you think of any income that is not taxable? So that if the accountant has included it in the statement, you'll do the nice thing of removing it because it's not taxable. Any income that is not taxable, Alima, any income we don't tax in this country, is it believable that there's any income that is not taxed in this country? We refer to them as non-taxable income. Can you think of anything that we don't tax in this country as an income? You've generated income, but it's not taxed. An example would be income derived from investments, foreign investments. So that income doesn't derive from Kenya. The Kenyan tax law will only apply within Kenya. So if you've invested in the stock exchange in Uganda and you earn dividends, it will be exempted from tax in Kenya. Or some people could be having investments in Dubai and you've earned income or investments from elsewhere, those will not be taxable in Kenya. Any other? Unrealized gains. There's a difference between what has already been realized and what is just on the computer. You know, accountants, as a rule, recognize gains even though they are not realized. And they call them, they'll tell you this is unrealized, but it's a gain anyway. Can you give me an example? Unrealized gain. So this could be a gain because of the fluctuation in foreign currency. So if, say, a company acquired an asset or acquired an investment or acquired materials at a certain amount, but the payment has not yet been done. And in the meantime, foreign currency exchanges in your favor. For example, you had bought imported stock, and the value of that stock was $1,000. At the time, probably the exchange rate was 130. So how much do you owe? 130,000. Let's say, just as an example, that the Kenya shilling strengthens, so that 1 month down the line, the exchange rate is 128,000. I mean, 128 Kenya shillings for the dollar instead of 130. So for each dollar, the company has gained 2 shillings. Now, that is called unrealized because the transaction has not yet been settled. But let's say later, okay, they are able to make payments. But instead of paying $130,000, the exchange rate now is at 126. So they pay 126,000. So we call that realized gain of 4,000 because that time the transaction has been done and the money is in our account. We are not just talking about currency. We are not just recognizing a gain because we've checked today and the central bank rate has shown that the currency has strengthened. We actually have this amount in our bank account. So usually, if it's still unrealized, it's non-taxable. So please, let's put down this statement of partnership profit. statement of partnership profit or loss. Then you say a partnership business will usually prepare an income statement for accounting purposes. We should usually prepare an income statement for accounting purposes. However, the reported profit or in brackets loss. However, the reported profit or in brackets loss for accounting purposes. However, the reported profit or in brackets loss for accounting purposes is different from the profit required. Is different from the profit required for tax purposes. Is different from the profit required for tax purposes for the following reasons. Put a column for the following reasons, column A, expenditure items, and we explain A, and we say there are certain items of expenditure. There are certain items of expenditure deducted for accounting. There are certain items of expenditure deducted for accounting purposes, which are not allowable expenses, for tax purposes, e.g., depreciation, impairment loss, amortization, write-off of assets, general provision for bad debts, stamp duty and other taxes. Then you say such disallowable expenses shall be added back. Such disallowable expenses shall be added back to the reported profit. When adjusting the profit for tax purposes. The next reason B, you put specified sources. Specified sources of income. specified sources of income, specified sources of income, and you say their profit reported, their profit reported for accounting purposes. Their profit reported for accounting purposes. Their profit reported for accounting purposes normally includes income. Their profit reported for accounting purposes normally includes income. Normally includes income from various sources. Normally includes income from various sources. Normally includes income from various sources. However, for tax purposes, income must be computed separately. However, for tax purposes, income must be computed separately. However, for tax purposes, income must be computed separately according to the specified sources. However, for tax purposes, income must be computed separately according to the specified sources. Any losses generated from a particular source, any losses generated from a particular source, any losses generated from a particular source must be carried forward. Any losses generated from a particular source must be carried forward to be offset. Must be carried forward to be offset against the same source. To be offset against the same source. To be offset against the same source that generated that loss. To be offset against the same source that generated that loss in the future years. In the future years. They say specified sources of income shall be deducted. Specified sources of income shall be deducted from the reported profits. Specified sources of income shall be deducted from the reported profit. In adjusting the profit for tax purposes. Then reason number C, capital expenditure. Capital expenditure. So we say the profit reported. The profit reported for accounting purposes. The profit reported for accounting purposes may include capital expenditure, such as cost of computers, partitions, furniture and fittings, motor vehicles, signboards, computer software, etc. Then you say such capital expenditure items, such capital expenditure items shall be added back. Such capital expenditure items shall be added back to the reported profit. Such capital expenditure items shall be added back to the reported profit in adjusting for tax purposes. In adjusting for tax purposes. In adjusting for tax purposes. In addition, investment allowances. In addition, investment allowances. In addition, investment allowances are granted. In addition, investment allowances are granted as a deduction. Are granted as a deduction on the capital expenditure incurred, as a deduction on the capital expenditure incurred, in acquiring of assets, that are utilized in the business. That are utilized in the business. Or that are utilized for the business. Should be for the business, huh? That are utilized for the business. Any questions so far? So we have 3 reasons so far. Any questions? Okay, the next reason is D. D, we talk about non-taxable incomes. Non-taxable incomes. And you say the profit reported. The profit reported for accounting purposes. The profit reported for accounting purposes. The profit reported for accounting purposes may include non-taxable incomes, such as profit from foreign investments, profit from foreign investments, unrealized foreign exchange gains, unrealized foreign exchange gains, or interest on drawings by partners, interest on cash drawings by partners, interest on cash drawings by partners, interest on cash drawings by partners. Then you say, normally, non-taxable incomes shall be deducted. Normally, non-taxable incomes shall be deducted. Normally, non-taxable incomes shall be deducted from the reported profit. Normally, non-taxable income shall be deducted from the reported profit in adjusting the profit for tax purposes. In adjusting the profit for tax purposes. In adjusting the profit for tax purposes. So with those reasons in mind, we can now look at the statement of adjusted profit. So next up there includes statement of adjusted profit, or in brackets loss for tax purposes. Statement of adjusted profit, or in brackets loss for tax purposes. Statement of adjusted profit, in brackets loss or adjusted profit, or in brackets loss for tax purposes. So based on those 4 reasons, because I said those are the main reasons which we'll be utilizing here, we'll prepare a format which will try as much, actually we'll stick to that format. That's the format that will help us going forward in preparing the statements which the examiner will be asking us to do. So your examiner will be saying, prepare a statement of adjusted taxable profit or loss, or for, like for us, to be for 2022. Why 2022? Because 2022 is the last complete year. You cannot be asked to prepare statements for 2023 because it's incomplete. Because you know, normally as a rule, tax is computed by reference to a period of 12. So that period of 12 months can only be in a complete year, in a calendar year. So we use 2022 because it's now complete. 2023 is not. Okay. So using those 4 reasons, we will be able to prepare a statement here, a format, and that is the format that will guide us in adjusting accounting profit going forward. So please write and say the reported profit. The reported profit for accounting purposes. The reported profit for accounting purposes can be adjusted. The reported profit for accounting purposes can be adjusted. The reported profit for accounting purposes can be adjusted to determine, the profit required for tax purposes, to determine the profit required for tax purposes as follows. To determine the profit required for tax purposes as follows. The examiner will be giving you a statement prepared for accounting purposes. Always, you get a statement that was prepared based on accounting principles and accounting concepts. Then he'll be expecting to prepare something like this. The statement of adjusted profit or loss. So he will start with the important. Pick that from the statement and you'll say, so we talked about expenses. So we'll go through this statement looking for those expenses we listed. Depreciation, looking for general provisions for bad debts, looking for taxes paid, what we had called disallowable expenses. So I'll generally call them disallowable. We'll be adding one item. Okay, it will not be one item. It will be a list of items. So I found depreciation, I've added back. I found general provision for bad debts, I've added back. I found stamp duty, I've added back. I found VAT, I've added back. I found corporation tax, I've added back. I found amortization, I add back. I found there was an asset that was written off. A motor vehicle, I've added. Slab expenses. We've also talked about capital expenditure. I've looked at the statement and I've come across furniture, I've come across computers, I've come across software, I've come across billboard, signboard, I'll add back. So it will be a long list. Here it's just a summary. So I'll add back those add-ons. And I'll say deduct. The accountant would have mixed sources there, specified sources there. There's rent, I remove it, because there are specific provisions for dealing with rent. There is dividend income, I deduct it. There's interest on drawings, I deduct. So specified sources. Sources of income. Yeah. Farming income, rental income, dividend, all the specified interest income, I'll deduct them under this category. Specified. I'm not written that correctly. I will also deduct non-taxable incomes. They've included unrealized foreign exchange gains. They've included income or profit from investments in foreign countries. They've included interest on drawings. I will deduct them under non-taxable income. I'll also deduct investment allowances on the capital expenditures incurred. Like if I have computers, I'll take 25% of the cost of computers. If I have motor vehicles, 25%. If I have partitions, 10% of partitions, and so on. So if I get these deductions, what I'll have arrived at is called adjusted. This is the adjusted taxable profit. So I'll have arrived at the profit required for tax after making those adjustments. Arrived the profit required for tax purposes, having done those adjustments. So do we have any question? Any question? Any question? Now, back to our definition for partnership. Even though we have this, it is very useful because it's the profit for tax purposes, but the business cannot be taxed. It is not a legal entity, specifically for partnership. We said it's simply a relation between persons carrying on business in common. So this is very useful for tax purposes, but it's just one of the steps. So we have to go to another step where this profit is shared, because the objective is to share profit among them. So we'll distribute this. It's called a distribution. We have to distribute that profit among the partners in their profit and loss sharing ratio. And you'll find invariably the exam will be based on those two things. The exam will be asking you to prepare the adjusted taxable profit or loss, and then you'll also be asking you for part B. You'll say, can you distribute that among partners? So even if the examiner did not say that, you will know that for partnership business, you cannot get taxable income without this. Because the business does not exist. So even if, okay, CASNEB normally will structure it for you. They'll tell you part A, prepare a statement of adjusted partnership profit or loss. Then B will say a distribution share. But even if they do not say that, then you cannot stop there. Because that one is not really for tax. You must prepare this other. Okay. So the distribution schedule will say a partnership is not recognized. A partnership is not recognized as a legal entity. A partnership is not recognized as a legal entity that is distinct. A partnership is not recognized as a legal entity that is distinct and separate from the partners. That is distinct and separate from the partners. It is formed with the motive of sharing profits. It is formed with the motive of sharing profits. It is formed with the motive of sharing profits. Hence, the profit of the business. Hence, the profit of the business is deemed to be that of the partners. And the profit of the business is deemed to be that of the partners. Is deemed to be that of the partners and is shared among them. And is shared among them in their profit or in brackets loss sharing ratio. In their profit or in brackets loss sharing ratio. In their profit or in brackets loss sharing ratio as shown below. As shown below. Repeat. So let's assume we have two partners here for purposes of illustration. Our partners are partner A, and we also assume they share profits and losses equally. Yeah? So if they share profit and losses equally, then this one gets half profits and partner B. So you're assuming there are only two partners in the business and they're sharing profits and losses equally, then you'll have another column, the total column, I would say shillings. Then we do what we call allocation. Allocation means you allocate to each partner any payment that has been made to them. For example, we first allocate interest on their capitals. So interest on capital is allocated. So partner A got interest on capital, say XX, partner B XX, and you put the total column. Simply allocate. That information will be in the question. They'll tell you how much was paid as interest on capital, or if they give you the percentages, you can simply work out the percent of the capital contribution. You also allocate salaries that will pay to the partners. Let's say A did not receive any salary, but B had a salary. Again, you put the total on the total column. If there was interest on cash drawings, that interest on drawings will become a deduction. Say A took cash, so we deduct the interest they paid. We did not take any cash, so the total of that is the deduction. Interest on drawings is the deduction. Then we will compute what they share as profits. Remember, the reason why they've been formed as a partnership is to share profits. So this is the purpose here, sharing. So we say share profits. So share of profit is worked out. So you leave space like that. So this is the main reason why they are together, why they are carrying on business in common. So you bring this, what you had adjusted. What you had adjusted for tax purposes comes here. Then putting the figure in your calculator, you say, this is in my calculator, I subtract the total. Only the total column, I subtract total interest and capital from this. I subtract the total salaries paid out, but I add interest on drawings. Why? Because interest on drawings was paid into the business. So it's added. So you take this in your calc, subtract interest on capital because it was paid to the partners, subtract salaries because it was paid to the partners, but add this because it is the partners to pay. So what you get as the final figure is what is shared. And you share it according to the profit or loss sharing ratio, which in our case is half. So half of this comes here, half comes here. Once that is done, then you get the subtotal of each partner. Partner A, you take this minus this plus this, you get a subtotal here. You get a subtotal for partner B, and you get a subtotal there. Now, this one was already there. If your distribution is correct, then these figures will automatically reconcile. If you add this plus this, you should get that. So either when you add down, you still get the same thing. When you add across, you should get the same thing. So what you've distributed there is just one source, because remember, we have deducted other specified sources. They have been deducted. So if there are other specified sources that need to be shared and taxed on the partners, this is the time you bring them in. For example, the partners could be having farming income. Already deducted the expenses. You give A his share, B his share. You don't put the total column. This one is closed. There is a specific type of dividend that is taxed twice. This dividend is dividend received from farmers cooperative society. So those farmers cooperative society you hear in the rural, like dairy farmers cooperative society, coffee farmers cooperative society, maize growers cooperative society, they pay dividends to the farmers. Those dividends are taxed again. So you bring them here. So these are dividends. And they are only one type of dividend. These are dividends from farmers cooperatives. They will get a share, they will get a share. If they are rents, I would not include rent here. Why? Because rent has its own rules. We talked about monthly rental income tax regime and standard rental income tax regime. So you could show their tax separately, maybe combine the taxes, but for purposes of calculating taxable income, I would not include rent here. So if those are the incomes, then I would add. And I would call this the total taxable income. That's for A, that's for B. So that if for whatever reason, if the examiner had wanted tax, then these are individuals, he normally gives you the scales to use, the graduated scale. And I will calculate tax, and that will be the end of the requirement. Because normally the first requirement is, can you prepare a statement of adjusted profit? Requirement number 2, can you distribute the profit among partners? So the only other requirement that could have been added could be, can you calculate tax? If it's there, then you calculate tax. So do we have any questions? That point, any questions? Any questions? Okay, so we will generally have this as our approach for partnership. And now I want to introduce some little adjustment you might need to make on specific cases. And I'll just look at 2 cases. Case of admitting partner. So there were A, B, then you have C coming in at some point. It could be similarly the case of retiring a partner. They started off as A, B, C. Then somewhere down the line, C is not there. So you only have A, B. What happens? So what would happen in case of admission or retirement of a partner is you are simply, the examiner will tell you that all revenues and expenses accrued equally. So he wants you to do some apportionment based on the dates. So how would the apportionment work? So in situation where all the expenses are uniform, like all the expenses that ran throughout the year. Okay, there can be a case where all the expenses ran throughout the year. So if all the expenses ran throughout the year, then the adjustment can only come in distribution. Because you don't have a problem. Everything was uniform. Everything was January to December, January to December, January to December. Then you'll come and adjust here. How will you adjust here? As an example, suppose it's an admission, C comes in, and C will come in July. So that the first 6 months we have A and B. Then from July we have C coming in. Then I will take interest on capital and I will split January to June. I have a portion. Then July to December, I have another portion. The same to salaries, the same to everything will be based on that. I'll split between the 2. Why do I want to do that? Because I want to calculate the specific amount that of profit that was there between January and June, so that I divide it between A and B. And the specific profit that accrued from July to December, so that I divide it between A, B, and C. So I'll do that adjustment. I'll be able to show, as an example, how the distribution schedule changes if A has joined them, or even if C has joined, or even if C retires, the same adjustment will happen. But then there can be a second form of adjustment where any expense is not uniform. It's possible that there is a particular expense that did not accrue equally between January and December. Let me give you an example. You can be told there are some computers, or there are some furniture and fittings, or there is a machine that was bought in July when C joined. Now, that means even this statement will have to be adjusted, because there is this allowance we will provide, but the allowance will apply for a specific period. Which period? From July. Because that's when the assets were acquired. The assets were not from January. So this statement can only be adjusted if there were expenses that did not accrue for the whole year. That's when you adjust this, you adjust this. But in instances where you've read the question and there is nothing that did accrue the whole year, you don't need to adjust this. You only adjust this. I will give that illustration in the next class. Because I'm not sure your head will take in all that. This same evening. So probably I can only ask for a question or two, so that you just go with the explanation. Then I will do the schedule for admission or retirement. Yeah, where I split each of the items, but I don't want to split that today, so that I start there in the next class. The next class is Saturday. Saturday from 11 to 1. So on Saturday from 11 to 1, I start from admission or retirement, where I'll only show with this. I'll give an explanation and show with this format. I don't know whether I can also have, okay, for an expense that didn't occur throughout the year, I'll only give an explanation. You have to adjust both, because it will mean the expense was not uniform. So I have to have income up to June, and from July, that's where I charge the expense, for example, of investment allowances when the assets were acquired. So let's start with that concept. Any question? Okay, we stop there for today.
Is it possible to update this class within the week? Also, on Saturday, some costs we are
You're working. You're also working. On Saturday up to 1. It would be tricky for me. And Halima, we are discussing about Saturday. How is your availability? Saturday? Halima, can you hear us? Okay, this is my proposal. Oh, she's free. This is my proposal. Let's record the class on Saturday. We still have it on Saturday, 11 to 1. We record. As we go on, let's review. Let's discuss. We see whether it's possible to make changes. But for now, let's work with maybe a recording on Saturday, and I hope they'll send the recording to you. Even this class is being recorded. There are people who didn't make it for this class. They'll be sent the recording. Let's do the same for Saturday, and let's compare notes if that's working. And you can raise any questions relating to the recording in the next class. Let's see how it goes. Then we can compare notes again.
It would be also good if they send the recordings in the same day, so that before the next class, I will have
Good.
Yeah.
What I will do is I will record the class on Saturday. Then I want you to contact Mr. Kimani the same day, because he's the one in charge of this. Okay? He's the one who deals with the recording. Contact him the same day, because after I've recorded, he does the rest. So probably be the right person to make sure it's forwarded to you. Okay, and then let me know in the next class. So make sure you go through it, and then you can bring in questions. Let's work with that. Then we see what happens down the line, right? So I think that's